Now let's sort of analyze and review an amortization chart and get a better understanding of how to account for leases. On January 1st, 2018, National Insulation Corporation leased equipment from United Leasing under a finance lease. Lease payments are made annually. Title does not transfer to the lessee, and there is no purchase option or guarantee of residual value by NIC. Again, NIC is the lessee. Portions of the United Leasing's lease amortization schedule appear below. So again, this is actually the lessor's amortization because both the lessee and the lessor would have to amortize a financing or sales type lease. So we've got our terms here. We see it starts on January 1st of 2018. We know it's the beginning here because that's our beginning outstanding balance of $192,501. Then we see that there are lease payments. Now notice our periodic lease payment happens to be $20,000 each period, so we can sort of find what the lease payment is. Now, one thing we haven't talked a lot about at this point is the concept of residual value. Here we notice there is residual value of 35. Now, this would be different if this were the lessee's side. This is an unguaranteed, so it says, notice, there is no guarantee of residual value by the lessee. So we call that an unguaranteed residual. In other words, the leasing company, the lessor, United, does expect to get this asset back at the end. And when they get it back, they have a strong indication that there will be a residual value of $35,000. So from the lessor standpoint, they're going to include that $35,000 as the last payment. Doesn't have to be a cash payment, it's equipment coming back to us, and we'll talk about that a little bit more. So let's answer some questions now that we have a feel for this. We know the terms here. We know that it's $20,000 per period. They're annual lease payments due on January 1st of each year. And then we also see that this has a residual value. Even though it's not guaranteed by the lessee, there's still a residual value on the lease for $35,000. So first question, what is the lease terms? Well, again, that just tells us how long the lease is in years. It's going to be a 20-year lease. Notice the last thing is 2038 when we actually pay or return that equipment to them. Starts in 18, so that means we know that this is a 20-year lease. Now, they told us it's a financing lease because we really don't have the information as far as the residual value. There's no, or excuse me, we do have the residual value, but there's no economic life listed, so we don't know. We also don't know the fair value of the asset, so we can't check for that. We do know that there's no purchase or no transfer of ownership. So we can check the first two criteria, but we cannot check 3 or 4 of the financing lease criteria. And we definitely can't check 5. There's no indication of the 5th criteria being met. So the only way we know that this is a finance lease is that it says it's under a finance lease. And there's an amortization chart, right? All right, so now, what is the asset's residual value expected under lease terms? We talked about that. Notice this last weird payment that's $35. The lessor expects to get the equipment back at a value of $35. Now that is an unguaranteed residual. Yes, I know that's not really a word. But it's not guaranteed, so I like to say it's an unguaranteed residual. Okay, so we go in and go there. Now, what is the effective interest rate? Well, you're like, wait, it doesn't tell me an effective rate. No, but we can sort of back into it. So what do we use the rate to calculate in a lease? Well, we use it to calculate the interest expense, right? The effective interest of the lease, of the loan here, so to speak. So if we know that piece of information, we can back into it. How so? Well, remember, to calculate the interest, we take the principal or carry value times rate times time. Now, since it's annual here, we really don't have to worry about that time because it's 12/12. So we can get rid of that. We know it's 12/12. So for an annual rate of interest, we know it's principal times rate gives us our interest expense. Again, times time. Time does matter, but since it's 1 year, we can ignore time in this problem. So what does that mean? Well, do we know the principal used? Well, absolutely we know the principal used to calculate interest. So here, notice 17,250 is our interest. We would have used 172,501. So that would be our principal. So if we go here and we do 172,501 times some rate of interest equals my interest expense, which I know to be $17,250. Now back to general algebra here, we need to solve for r. So to do that, we're going to divide each side by the 172. So the rate equals 17,250 divided by 172,501. So if you take the interest amount divided by the principal, that's going to tell you what rate was used. And when we do that, we get a 10% annual rate. Now, what if this were a 6-month payment? Well, once you got your rate of 10, you'd times it by 2 because that would be a 6-month rate and you get 20. But this is an annual payment, so whatever your terms are sort of indicates that. So since this is an annual payment, we can just simply take that divided by that, and that gives us the 10%. So take the interest expense divided by the principal that would have been used to calculate it, and it gives you your rate. Okay, number 4. What is the total amount of lease payments for United? Now, again, United is the lessor. So what are they going to expect to receive? Well, they get $20,000 times 20 years, so they're going to get $400,000 in lease payments. But that's not it. They're also expecting to get a payment in the form of equipment at the end for $35,000. So in total, they expect to receive $435,000. Granted, the residual value is not guaranteed, but it is still expected by the lessor. Now, what is the total amount of lease payments for the lessee, NIC? NIC could care less about that residual value. It's not guaranteed. It's not going to impact me in any way, shape, or form. So as the lessee, I'm just going to take the 20 times the actual $20,000 in payment, and that's going to give me the $400,000. Again, we do not worry about the residual value as the lessee in this case because it's not a guaranteed residual. All right. Now, what is United's net investment at the beginning of the lease after the first payment? I'm not sure exactly why, but we know their initial is $192,501 because that's the present value of the lease payments for United. Okay. And then we're going to take that, and it says after the first payment, so we're going to take off that $20,000, and that means our net would be $172,501. Again, not sure why, but it does why they're asking that, but that sort of gives you the hint. It's 192, but after the first payment, our initial is 172,501. Okay. Now this one is more interesting to me. What is United's total effective interest revenue recorded over the term of the lease? Now, a couple of ways we could get this. If we had the full amortization table, we could just simply add this column. Sadly, we're missing quite a few years right there in between 2023 and 2035. So what would we do to go about getting the total amount of interest? Well, we know that there's going to be $435,000 in payments, right there. So $435,000 in total payments from United's standpoint. We're going to get 20 payments at $20,000 plus we're going to get the asset back at the end for $35,000. So that's our total payments. Then how much of that is going to pay the actual principal? Well, $192, because that's the amount of the principal of the lease receivable for the lessor. So if you take that minus the $192,501, that would tell you that we expect to have interest revenue here of $242,499. So even though we don't have the full amortization chart here, all you have to do to find your total interest, you know what the loan, so to speak, starts at, the lease receivable or lease payable. But it's a receivable because this is from the lessor standpoint. The $192,501. We know that our total payments is $435,000. Every time we make a payment, a portion of it goes to interest, and the rest goes to decreasing the balance. So we know, since we can't add this column, we know if we take the total payments of $435,000 minus that initial loan balance, that tells us how much would go to the effective, because this column will equal $192 if you were to add it all up. It would come back to this number. So the difference then is your interest. So that's how you could sort of find your interest revenue, or you could do it the opposite. If you had the lessee, you could find the interest expense. All right, last thing it asks is, what is the right of use asset? Since this is an unguaranteed residual, the residual is not guaranteed by the lessee would record the asset at the PV of the minimum lease payments, or the periodic lease payments. Those are interchangeable. So PV of the lease payments, the periodic lease payments, the minimum lease payments is how I learned it. So I always call them PV of minimum lease payments, but I think periodic is more common now. So how would we do that? Well, we're only going to make the $20,000 payments, and that's it. We're not worried about the residual because it's not guaranteed by us. We don't have to pay them the $35,000 if the asset's not worth that. So we ignore the fact that the lessor included any residual value at all. So we're going to take the $20,000. We're going to do the PV. So we're going to use the PV tables. So pull out PV tables, and we need the PV of an annuity due. Why is it an annuity due and not an ordinary annuity? Well, notice, when is your payments due? Well, the lease started on January 1st of 18. The first payment was also due January 1st of 18. So that tells me our lease payments are due at the beginning of the lease term. So since it's due at the beginning, we're going to use a PV table. So you're going to go and find your PV tables. And I'm just going to make a note. You're going to use the present value of an annuity due for this one, because when it's due at the beginning, it's an annuity due. When the payments are due at the end, it's an ordinary annuity. So y'all run out there and look up that table. Now the next thing we need to know is the N and the I, the number of periods, and then the overall interest rate per period. Well, notice this was annual payments on this lease, and the lease was for 20 years, so 20 annual payments. And then we need to know the I, or the interest rate. The interest rate would be the 10%, because it does tell us, right? Well, it doesn't tell us, excuse me. We calculated that rate right there, the 10%. That's the annual rate, and since it's an annual payment, we'd use the full 10%. When you look that up on the table, you hopefully get 9.36492, unless I'm looking at the wrong spot, but hopefully my eyes are not deceiving me tonight. Now, when we do that, we get 187,298. That is, for the lessee, their present value of the periodic or minimum lease payment. Okay? What about that? You're like, wait a minute, that's weird, because that number and the lessor's present value of the minimum lease payments is not the same. Well, when there's residual value, you may have a difference between what the lessee would record and what the lessor would record. If it's not guaranteed, we as the lessee would not even really know that they had included this $35,000. So we would go based solely off the information that we're making $20,000 payments and that we have a rate of 10%. That's what we would go off of to calculate our right of use asset. So that's what we would record it at. So how does that impact the entries? Well, I don't know the fair value of the equipment, so I do not know if they're selling profit or not. So I'm going to say from the lessor standpoint that there's no sales profit, that this is just a normal finance lease, that they didn't manufacture it. I don't know the answer to that, but I'm going to assume. So we would debit the lease receivable, and they would do it for the $192,501. And this is the lessor, and then they would get rid of their equipment. Again, I'm assuming this is just a sales type with no sales profit, so we're just doing the $192,501. What would the lessee do? Well, the lessee would record the right of use asset here, and they would record that for the $187,298, and then they would hit the lease payable. Notice they are different, because we as the lessee are not anticipating that $35,000 residual value. Okay, so that creates that slight difference. I mean, it's not a huge difference, because $35,000 when you bring it back to today's dollars for 20 years isn't a huge number. Okay, but that's what creates the difference there. So can I prove out why that's the case? Well, yes, we can, because when there's that residual value and it's unguaranteed, so when there's a residual value not guaranteed by the lessee, so that's what this problem is. The lessor would calculate their present value by first finding the PV of the lease payments, the periodic lease payments. I'm just going to do PLM, how's that? Or PLP. Periodic lease payments, there you go, just for saving time's sake. Now how would they do that? Well, they would do the 20,000 times the same thing we did wherever it was at, 20,000 times 9.36492. 9.36492. So let's grab this. So they would do this too, and they would get the 187. But remember, they don't have to worry about the 35, so they're going to do the PV of the residual value. So how would they do that? Well, the residual value is 35,000, and we need the PV factor. Now, for this really quick, I do have a PV table here. Let me see. You probably can't see it so well, so let's drag this over. So it's tiny, I know, but it's going to be 20 periods at 10%. So right there's our PV factor. We're using the PV of 1 because the residual value is just a one-time payment. That is a little bit different from when we were talking about the present value of the lease payment, because that's an annuity. Here we just have a one-time payment. So we go to the PV of 1, so that's 0.14864 if memory serves. Now let's multiply that out. What do we get? So we take that rate, multiply it by that present value, and you get approximately 5202.4. Okay. Now notice this number is rounded, so if we hadn't rounded this, then we're going to round this to 02. But if you add those two together, take the 187, 298, plus the 5,202, you're going to get the present value that the lessor would carry theirs at. So that's plus 187, 298, and we get 192,500. Now why are we $1 off? That's just rounding. So if we had not rounded, listen at me. If we had not rounded, we would have got the same 192,501. But that's just a rounding difference. So notice when you have that unguaranteed residual, the lessor has to include it as part of their calculation. So they would carry it at the PV of the lease payments plus the present value of that expected residual that they're going to get the asset back for at the end, and that's going to give them what they would carry the asset or remove the asset at. That's the lease receivable for them. However, the lessee, since it is not guaranteed, the lessee completely ignores it, so they only recorded that the PV of the lease payment. So that creates a slight difference between the lessor and the lessee. Again, you wouldn't do the accounting for both in this case, but that just sort of gives you the example there so that you can see what happens when there's an unguaranteed residual value. So hopefully this has helped clarify a little bit about how you can read an amortization and how you can deduct different things just by looking at the amortization chart.